In the first learning objective, we discussed what an investment philosophy is and how it's important. As part of that, we identified the importance of personal characteristics being embedded within a philosophy. Following from this, the second learning objective is to describe the personal characteristics that need to be considered when deriving an investment philosophy. So there are three main personal characteristics that an investor needs to take account of. The first of those is risk. An investor needs to consider the risk-return trade-off and their own preferences towards risk. Now, what we know is that investors have a range of different appetites toward risk. Some investors are highly risk-averse, which means they'll only be willing to take on risky assets if they're rewarded with an extremely high return for doing so. Other investors who are less risk-averse are more inclined to invest in risky assets, hence they don't need to be rewarded with such high returns in order for doing so. So you need to determine your own degree of risk aversion, because some investment philosophies inherently are going to be riskier than others. If you're highly risk averse, you should not invest in an investment philosophy that requires that appetite for risk. Now, it's actually quite difficult to evaluate investor risk. A number of ways you can do this. You can maybe take a survey, or you can consider your own historical investment patterns and use that to identify what your own risk appetite is. But as a general rule, the more risk averse the investor, risk aversion means you do not like risk, you're averse to the risk. The more risk averse the investor is, the less of their portfolio they should be investing in risky assets, such as equities. The second issue to consider as part of a personalised investment philosophy is time horizon. An investor needs to identify how long they're currently willing and able to invest for. So some investors will have patience to hold investments for long periods of time, while others will not. Equally, some investors might have cash needs in the short term, whereas others have no need for cash in the immediate horizon. A good example here is to consider investors at two different stages of their life cycle. So you could have, for example, a young 25-year-old investor who is putting money away toward their superannuation to be able to pay for their retirement in, say, 40 years' time. Whereas you might compare that investor to a 65-year-old who is on the brink of retirement and is looking for a shorter-term investment, something that they want to draw down on as they enter the retirement years. Obviously, these two investors are going to have different approaches to how they go about investing their money. And one particular point to note is they should also have different degrees of risk aversion. That is, if you've got a shorter time horizon, you can ill afford a short-term drawdown in the investment. Whereas if you have a very long time horizon, like the 25-year-old example I gave before, where that person had 40 years to invest, a short-term drawdown is not such a big issue because there's many years which that investment can recover. So as a general rule here, if you've got a longer time horizon, you can invest a greater proportion of your wealth in risky investments. The third thing to consider is the tax status of an investor. So investors are only concerned with their after-tax returns. Therefore, taxes do have an effect on portfolio composition. So we know, for example, in Australia, there's a tax system known as the imputation tax system, and that tax system results on dividends and capital gains being taxed differently. In a nutshell, what we find is that because dividends are taxed at the investor's personal marginal income tax rate, then investors who have a lower income tax rate, such as, for example, retirees, are going to prefer investment strategies that have higher cash dividends versus those investors who are in the top tax bracket, those that have a high marginal income tax rate. Other factors to consider in terms of tax status might also be where you're domiciled. So tax rules could be different for domestic versus international investors, and that might also have an impact on the portfolio composition. There's some complicating factors that need to be considered in terms of tax status and how they also affect one's investment. For example, there might be different tax rates on different proportions of an investor's savings. So we know, for example, in Australia, there is a concessionary discount tax applied on superannuation. That might mean that the tax treatment of superannuation differs from the tax treatment of other savings, and hence the philosophy for investing those two different proportions of one's wealth might differ, even though we're looking at the same individual. We also have to consider the fact that tax rates may change across time, and tax policies might change across time, and that could be a regulatory risk that investors want to consider. So in summary, we've looked at the three key characteristics that investors need to consider when they're forming their investment philosophy. That is their degree of risk aversion, their time horizon, and their tax status.